All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be talking about the concept of pegging. Now, when it comes to pegging, such as soft peg and hard peg, okay, your soft peg has to do with the central banks letting the market decide the exchange rates. So this is sort of like an intervention, okay, just like you have government intervention, okay, or the intervention of the central bank when it comes to their monetary policies. This is one sort of an intervention. All right, so soft pegging, which is an intervention from the central bank, for example, this has to do with a type of intervention where a type of intervention where the central bank lets the market decide as to what the exchange rate should be. Okay, so in a market economy, we have demand and supply. And based on demand and supply, we have exchange rates. Okay, so type of exchange or type of intervention rather, where the central bank, where the central bank, the central bank lets the market decide as to what the exchange rate should be. Okay, so this is letting the market economy decide as to what the exchange rate should be. And there are a bunch of factors that decide this exchange rate. We've talked about components of GDP, we've talked about aggregate demand, aggregate supply, so on and so forth. All right, now apart from this, your hard pegging has to do with the intervention of a central bank when it comes to figuring out or creating exchange rates. So this is hard pegging. This is intervention of the central bank. Intervention of a central bank. Okay, where the government or the central bank decides, where it decides what the exchange rate should be, where it decides what the exchange rate should be. Now, in terms of hard pegging, the intervention is on a regular basis, which means the central bank may intervene on a regular basis and decide the exchange rates based on the factors that we'll talk about in a bit. Okay, and in terms of soft pegging, the government or the central bank in this case may occasionally decide to interfere. So the interference or the intervention is not as regular as it is for hard pegging. All right, and the reason for the intervention when it comes to the central bank include but not limited to stimulating demand and increasing exports. All right. And when it comes to stimulating demand, stimulation of demand, let's look at a graph over here to understand how this works. Okay, so let's say this is your aggregate supply and this is your aggregate demand. Okay, and this is total currency traded, for example, total traded or total exchanged or traded. And over here, you may have the value of the exchange rate of the currency, so the exchange rate. All right, so we know that this is the equilibrium, and if the central bank decides to do a hard peg and decides to keep the interest rates, or in this case, the exchange rate, excuse me, exchange rates below the equilibrium, okay, what's going to happen is the aggregate demand will be more than supply. So this is sort of like a deficit. Okay, aggregate demand is more than aggregate supply. All right. And when it comes to pegging the exchange rates above the equilibrium, okay, this is sort of like your surplus where aggregate demand is less than the aggregate supply. All right. Now, the reason why the central banks may decide to keep the exchange rates below the equilibrium point where aggregate supply and aggregate demand meet is because of exports, net exports. By keeping the exchange rates low, the government or the country in general would be able to export more, okay, at a lower price. Okay, so the price of goods and services may be less in the economy, the exchange rate will be less, as a result of which, okay, the foreign investors will be more than happy to invest in the country and they'll be more than happy to buy goods and import goods from the country to sell them in their own countries, okay, at a higher price. All right, so this is to attract foreign investors and net exports, attract foreign investors, and increase net exports. And the second reason why the central banks may decide to keep the exchange rates below the equilibrium point has to do with stability. All right, so this has to do with stability. And when it comes to stability, we're talking about government setting a target exchange rate for stability in the economy. So this is stability. Okay, target exchange rate within the economy. This is target exchange rate in the economy. And the third one has to do with long-term purchasing power parity. Okay, so long-term purchasing power parity. And we talked about long-term purchasing power parity. This has to do with your market exchange rate. All right. And this was relevant to using GDP to figure out the exchange rate, where the exchange rate will be GDP over the currency in the home country, okay, or the home currency, divided by the currency of the foreign country. All right. So this is your long-term purchasing power parity. All right. And this is sort of like a reference point. when it comes to figuring out how the exchange rates are doing. Okay, so to keep this stable, okay, if the government or the central bank in this case decides that the exchange rates at equilibrium might be too high and that they need to lower down these exchange rates to a point where their exchange rates would be stable over a long period of time. Okay, they will go ahead and lower down these exchange rates by using this procedure over here, which is called hard pegging. Okay, so lower down exchange rates. This is exchange rates. All right, so that would be it when it comes to the concept of pegging. On behalf of V Electronics, this is Obey. Have yourself a great day.